today we're going to talk about market structure, right? And the overall directional bias, because those two kind of work hand in hand with each other. So what is an overall directional bias? Overall directional bias is basically which direction the market is headed overall. So for instance, if we're just looking at this pair that's on my screen, we can see that the overall directional bias, you could say, is downwards. I mean, in a sense, let me look at daily. You can kind of say it's on an upwards trend, like a little upwards trend, right? So that's understanding the overall directional bias of the market is trending up, right? So once you understand the overall directional bias, then you know more than likely you're looking for buys more than sells, if that makes sense, right? Because the market is clearly trending up. So after understanding, the overall directional bias, the market moves in a way that it wants to create higher highs and higher lows, or lower lows and lower highs. So that basically means that they like to step price like that, right? So if we were to look, this would be a downtrend, right? So this would be a lower high, right? And this would be a lower low, lower high, lower low, lower high, lower low, lower high, lower low, right? So understanding that, they're just walking the price down. This is basically market structure in a downwards trend, because it's creating lower highs and lower lows. So I mean the market is continuing to go down, right? So in the opposite, right, you have the upwards trend, right? So this would be a higher low. This would be a higher high. This would be a higher high again, a higher low, higher high, higher low, higher high, higher low, right? So understanding that price is making a higher low than the previous low, right? So just seeing it walk itself up, continue to make higher highs and higher lows, that would be on your uptrend, right? So basically, this is where we can get into the market when it retraces back down to make either that higher low, or retraces down to make that lower high, in the downwards trend. Or we're in the upwards trend, we're probably going to try to get in at the higher low to make the next higher high, if that makes sense, right? So if we were to look at example, delete all this. It's got to be an easier way, but I don't know it. All right, so we're looking at a chart. We're just looking at a chart. Oops. And we want to see a nice market structure. Why does it keep doing that? Market structure walking itself up or down. So this would be an example of the market structure in a downward trend. right? Overall directional bias is down, right? So if we were to get into the market, we know the market is trending downwards. After it broke this low right here, like after this low got broken right here, and then this low got broken, and this low got broken, and so forth, then you can know that there's definitely a downwards trend going on. So you can clearly see the market creating lower lows and lower highs, right? I don't think I need to keep, marking these up. But you can definitely see how market structure is wanting to go down, overall, because literally it's just walking itself down. So if you're understanding the market structure and the overall directional bias, you understand that where you can get into the market. So of course, trends are going to be your best ways to get into the market, because that way you can stack positions. And what I mean by stacking positions is like, going in for the retest basically to continue to go lower. For instance, this is on the daily, so it's a little bit tougher. Let me go to the 2 hour. Wait, where's my downtrend? Okay, wait, hold on. Okay, this is my downtrend. All right, so you see the market making lower lows and lower highs and all that, right? So understand that when there's a break of structure, so this right here would be the break of structure to change the direction, basically, because it basically broke that high. It didn't make a lower high, it made a higher high, right? So when it makes a higher high, you can expect the market to start trending in a different direction, which it started to do. If you can see those lines, let me make them red or something. So you can see the direction basically switch after it broke structure right here. So after it breaks structure, you can be expecting the next higher low to make the next higher high. So this, in this instance, this would be the next higher high. Then this would be the next higher low to make another higher high later on, right there. So understand that the market's doing this. This is where we like to get into the market, because we know that the market plays off of institutional candles and imbalances, right? So when it broke, when it rose, when price went up, it left an imbalance, right? It left a buy side imbalance. And what a buy side imbalance is, basically nothing but buys in this one area going up, right? So in order to balance price out, they have to fill this line up, this area from that wick, from that wick to this wick. In between it, you have a straight line. So that means that's a buy side imbalance, right? So being it is a buy side imbalance, they have to put sales in this area. Let me just highlight it. Right, they have to put sales in this area. So we want to extend this out, right? Look what price did. Price literally came into the imbalance, filled it in, and to continue to go higher. Why? Because they just needed some buys in this area. They just needed sales in this area to balance price out, because this one imbalance was nothing but buys. So they had to put sales in there, and that's what they did. They put sales in there, and then they made a higher high. So understanding market structure, higher high, higher low, higher high, higher low. You know, even right here, this right there, it's a higher low, right? To go up, right there, to make a higher high. All you're doing is just, identifying the tops and the bottoms and seeing which way the market is moving. Now make it a higher high. So, what can we, maybe we can expect some type of, you got the same imbalance. You see the same, you see the imbalance, imbalance right here, right? So, maybe we can expect price to go down to this area to make hold on. All right, make it higher. That could be the higher low, or this could be the higher low, right? To make a higher high to 2200 whole level. And 2200 and whole levels do play a significant role when price wants to react off it. So that's a perfect example of the breaker structure to continue to go higher, because at first we were in a downwards kind of trend. Actually, it's kind of consolidating, to be honest. It's kind of sideways in a range, but once it broke out of that range, and to show you the range, I'm just going to mark it up for you. So from this high, from this low, was the range that it was in until it broke out of that range by taking the money on the downside. And all I did is take the money on the downside just to take the money on the upside. You can see that. So you see the current range that it was trading in. Once it broke structure, it just continued to go higher, and you could just, ride this thing all the way up. But, hey, Jesus Christ. Like, what do you want? Like, you need to go outside? Go out. You know what? Come on. Let's go. Take your ass out there. Don't come back. Is that making sense?
Yes.
All right. So, what's your questions?
I don't have questions. Keep going. I'm just writing as you go.
All right. So now that we talked about market structure, well, we got the upward trend. Let's get a downward trend. Matter of fact, yeah, let's get a downward trend. Let's get a downward trend, so we can see the same thing going on and where we can get in the market on a downward trend. I like this one. This is cool. So we're doing the same thing here, right? Market broke structure at that point right here. That's the breaker structure because it made a lower low. You know what? Maybe I should just type it, huh? right? Get the breaker structure there. So now we're expecting the market to make a lower high, right? Which would be here, to make a lower low, which was here, right? To make a lower high, which is here, to make a lower low, which is here, and so forth and so forth. So where can we get into the market on this downwards trend, right? Right. So this would be a good example of where we get in at. So we have something called a smart money cube, which is the continuation to go downwards or upwards, but it looks like a cube. So let me delete this real quick. This would be considered a smart money cube because, I mean, why? Because what they did is have more orders in this area to fake the market. So what they wanted to do is entice more buyers, like it was going to go up. Like, you see how this low is higher than this low? Like this low right here is higher than this low. So they wanted to entice buyers that the market was going to go up. All right. So what they did, they have orders sitting at this area, which is around the 80 level anyway, which is 0980, which is a 80 level, 80 and 20 level. You know, they have this downwards push, right? Then they have orders sitting here to fake buyers to go up just to sell it back down. So that means smart money plays in this area, right? So knowing that smart money plays in that area, how would we actually, you know, mark this thing up? You know, it's to actually get into a position for the sell. So what we would do is look at the short position, correct? We can go from the bottom of that last candle, right? So what I mean by the bottom of this, I mean this candle right here. So we're looking at that blue candle, right? This is a box around the blue candle. So we know that they're sitting inside of this candle. So whether they want to sell the market down or sell the market up, it's going to get a reaction out of this candle. Why? Because you had to push down, you had like a little slight correction and the huge push down. So you got the institutional candle. This can be your institutional candle. This can be your imbalance after they push the price down. So understanding that they need to come in to fill the imbalance, right? That is a clear imbalance in the market. I'll change the color of this because it's not institutional. Send to back. All right. Same thing with this one. Send back. So this is our institutional candle, right? So if we know that the banks are hiding behind that candle, this is a good indicator that we can get into the market for it to trade lower because we already understand that it is already in a downwards trend. So where we put our entry, we can put our entry at the beginning of the blue candle, which, you know, which is at the edge of this box. So that would be the opening of that bearish candle, I mean that bullish candle, right? It'd be the opening of that bullish candle. So I would step my entry here. I don't expect for it to go above the high, right? So I don't expect it to make a higher high. I'm just expecting it to make a lower high to continue to make a lower low. So I would put my stop above the high and I would target the next low because I know it's going to make a lower low, right? So knowing that it has to go past this low, you know, that's going to be my target. So I was to play that right there, that would have been a winning trade because I understand the overall directional bias of the market, understand where smart money lies in the market. I understand that they leave an imbalance right after they push the market down because nobody else can cause this much of a downwards. I'll just use this much of a downwards push in the market. That's a huge downwards push. That takes a lot of money for them to push the market down like that. So we know the banks got in here. They brought the market just to sell it down, right? So what do they need to do? They have to come back to mitigate out of the zone. Basically, what a mitigation means is they're actually closing that buy position they did here to to sell it off. So when they came back up here to this price, they closed that buy position, right, and just sold it again. So this is how the banks basically use our money. This is how the banks manipulate the markets. This is the bank actually getting in the market, and this is us taking advantage of the banks in the market. This is why we trade with the banks, because the banks have the biggest movements in the market, and we can just ride the wave with them. Make sense?
Yes.
Questions?
No.
All right. So we talk about market structure. We talk about overall directional bias. So let's talk about when market structure is in a range and how we go about marking that up. So let's find a consolidation range, which would eat some of this. This would be considered a range. All right, so this would be considered a range from the high to the low. And if price is actually sticking in that range, then is inside of a range. So understanding this thing's inside of a range, where are we looking for buys and where are we looking for sales? So how we break up this range is using the Fibonacci retracement, which is highlighted on my screen, right? You pick your high, then you pick your low. And basically, I'm gonna switch this around. Basically, these are key levels where price can play off of. If you don't know the Fibonacci retracement, it's something you just gotta look into. It's a whole explanation. But discovering what part of the range that you're in, right? If this is your high, we're gonna split this range up to 50%. All right, bam. That's the first part of the range. And bam, after 50%, that's the bottom half of the range. Right? Mm-hmm. So look at this as premium and discount price. Man. Don't do me like that. My handwriting's not the best. Make sure it can. Premium. discount. So if you were to buy anything, right, would you buy it on premium or discount price? Discount. So you know if it's in a range, right, you want to get the best price you can. And knowing the Fibonacci retracement levels over here, right, these key levels is what price is where price likes to react off of. And you can clearly see where the market came down to the 88%. Okay. 88% right there, right? That's 88.6%, right? Then it stayed on the next level right here at the 78, right? After it broke from there, you know, where did it go to? It went right to 71, then bounced off of that, right? After that, after it hit the 71, it was gone. It was gone. So understanding that, you know, you're looking for buying opportunities and discount price, and you're looking for selling opportunities and premium price. If you're traveling the range, if you're in a range, if you're actually like trending up, then this will not work. Because like I said, market structure is giving you something different. It's giving you your higher highs and your higher lows. So that's mostly what you're going to be, you know, trading off of versus, you know, these Fibonacci retracement levels, you know, in the range is kind of different because it's consolidating in this range. It's not trending, if that makes sense.
Yeah.
With me?
Yeah.
All right. So you got that. All right. Discovering the range. And um let's do a little bit more deeper, because I think you're at that point now. So one thing to understand about Euro USD is that the dollar index, which is right here, the DXY, is the dollar index is made up of 50% euro. So anything the DXY does, damn it, it's gonna be too sloppy. So where'd it go? All right, whatever. So you can kind of, you kind of see that, you know, it's doing basically the opposite because they correlate with each other.
So I like the mirror that we were talking about, how it just looks like flip.
Like what?
It just looks flipped.
Yeah, it's just flip. Yeah, it's just does the opposite of the DXY. Euro does the opposite of DXY. So this can be an indicator where you can use to actually, you know, see what's really going on, you know, in the market. For example, if you know that, you know, delete that if I can. So we know that the DXY, we're just even looking at like, overall bias or where direction of what's going on of the DXY, right? DXY is the dollar index. We can see this thing is very bearish. So that means Euro USD is going to be bullish, right?
Mhm.
So that being said, you have to see where price is going on the dollar for it to like, get a kind of idea of where euro is going to go. So you can see where I have marked up, I have an institutional candle, right? Which is here. You can even see on the left side, on the right side, I have the open of the candle, which is the first red line, which is right here. That's the open of that candle. And you can see where I have IC candle wick, which is, IC, should be see IC wick, institutional candle wick, is 2 price points of where price could react off of. And you can see how price literally punctured this candle, right? Because you're following the red line, that's the open of the candle. So it went inside the open of the candle, which is a monthly institutional candle, which means it's going to have some. All right, so if we're understanding that this is a high reaction level, then we can expect price to either give us a nice reaction up, which it could just come into, this is on a monthly time frame, which is kind of big, but it could come in to, do something with this imbalance here, right?
Mhm.
Or it could come up to that imbalance right here, which is, kind of far, but this is the same exact thing that we see on the 5-minute, the 1 hour, all that, because literally it's the same exact thing. This would be your imbalance, right? This would be your imbalance. The red would be your institutional candle. You can see that right there. If I'm just, making sure you see the same candle, I'm just going to mark it. All right, that candle right there. We have the imbalance right above it. Then you can see where price came down, filled the imbalance. It's not a coincidence that, price closed right at the end of the imbalance. Like, that's not a coincidence. That's just how precise we are in the market to see what's really going on. Of course, it traveled down into that candle, but it closed. Well, price is literally at that at the end of that imbalance. So you could see a reaction up at this point, which means the euro would be going down, because at this point it is in an imbalance as well. Here, right? Just train your eye to see the imbalances right there from the wick to the wick, empty area. And you got another imbalance, of course, right below it, but it already ran through there. You got some type of reactions at first, right there, right? It fell. Like I said, price is going to react to the imbalance of institutional candles. It might not be like the biggest move, but it's going to be a move. The crazy part is, this is the same wick that I marked up in the range. And look at this another imbalance right here. What did it do? It went into an imbalance just to go back into another imbalance. Literally tipped that imbalance just to trade higher. And now it went inside of this institutional candle. Not yet. It's inside the wick. It went inside the wick of it, but it didn't go inside the actual candle yet. Let me actually put a square around that. All right, bam. That would be your institutional candle. All right. So now you can see the price actually poked into the institutional candle a little bit. and we got a reaction off of it. So what this means, we could actually be going lower. And it's crazy because that whole level that we were talking about, that that this black line is at 2200. 2200 is basically at the open of this candle as well. So, maybe when it hits that 2200 level, we can expect price to stop dropping, because price likes to pays off of whole levels, and it likes to play off of institutional candles, and it likes to play off of imbalances. So, that being said, we can expect some type of reaction off of that to go down to maybe fill in this imbalance there. which which wouldn't be too bad. But that's how the DXY and Euro USD correlate with each other. Literally, you can see that they're the opposite. They're the opposite. And understanding that, the bigger time frame analysis is just as important as the smaller time frame analysis. Like you marking up your institutional candles on the monthly and marking up imbalance on the monthly is just as important as you marking up on the 1 hour. Because right now we're inside of the imbalance. We're inside of the imbalance. Let me delete this. See what's really going on. So before I end it, I'm just gonna nice little setup that we were looking at last night. If we were to play the imbalance, of course, right? See the imbalance. I'm gonna put this one, the wick before, and put this one, the wick after. You can see the clear imbalance. Right there. Right. You have the breaker structure. You have the breaker structure on the left side. So this is why we played it, because it gave us all the signs. That's not necessarily means it's gonna give us everything that we want, but this is what we want to see. Sometimes, the market just does what it wants to do, but you had the breaker structure there, right? So now it has to come back and fill up this imbalance. I had my entry. I wanted to get in it, but I didn't get in it because I was in something else, and our market executed it, so I wasn't really paying too much attention to it. But if we were to mark up the 50% of the imbalance, right, using the fib, right, use a horizontal ray, put that in the middle, delete the fib, right? So now look at that. None of the stuff on the left had happened yet. So we were waiting for this to get down to that area, right? Because at this point, it's creating liquidity in the market because it's trading sideways. So everything that was above here was sitting money, right? Because the market was just, trending sideways. This is the market trending sideways. It's not doing nothing. So being that it was money sitting right here, what they did at London is come down to take the money out. We had an entry right here. You can see how price literally respected the 50% of that imbalance. And you can see that this last little candle here, these are the candles sometimes you want to play as well. I mean, I don't know if we want to call it. I mean, this can be considered the institutional candle, right? Institutional candle. And look where that blue line is. That blue line is at the 50% of the imbalance. But literally, if you just was to like put it at the open, for that candle right there, you would have got in perfectly in the market right there. You would have had your stop below the low there, which is 5 pips, which is $5 for, $5, $500, whatever the case may be for your 36 or whatever the case may be, because that's a 7-to-1 trade. So that means you're getting 7 times more than what you're risking, which is a good deal in my eyes. And this happened in all this happened in 1 hour from 2:15, 3:30, 3:45, 3 o'clock, 3:15. Within an hour of time, you could have been paid, depending on your lot size, 37 pips, which like I said, it could be $37. It can be $370. It can be $3,700, or it can be $37,000. Doesn't matter, but because same skill set, same. You can make any amount of money on it. It's just you just have to realize the skill set provides you with the opportunity to make that much money. So that's something we were looking at last night, and now, since this is when you read market, like, okay, the market left these double highs, right?
Mm-hmm.
See the double highs right there?
Yeah.
So knowing that it left those double highs, we know that money is sitting above here. So this thing could be trading in a range at this point. Before I do that, let me delete this blue line because we understand what that is. It could be trading in a range right now to create money in the market, which would be from here to here. You know what a range is, right?
Mm-hmm.
So, being that it's in this range, what it could do is break out of this range. It has a tiny imbalance. You can see that imbalance right there, right? You got that tiny imbalance right here. Right? So now what we probably can expect price to do is react off of that zone right there. Break the range, right? Because it's currently in a range. You're looking at the 2 green lines. I make it a little thicker so you can see. Swing high, swing low, right? Prices in between these 2 points. So you see the current trading range, right? Purple lines. Prices basically stand in between these 2 price points. We understand that the banks like to do what? They like to buy the market down, take the money out that's sitting on the sell side, just to take the money out that's sitting on the other side, like that. So if we were to mark this up, what would we mark up? We use a long position, right? Because we're looking for the buy. We can play the opening of the imbalance. We can put our stop below the low, which is about 15 pips. You don't even need to play that low. You can play like that low if you wanted to, which would be about 8 pips, which isn't bad. But you can play, the 15 just to be on the safe side, because you're not expecting to go below that low, right? You're not expecting to go below this low. You're expecting price to respect that low to make a higher high. To make a higher high all the way up here, to be honest. Because right now we're kind of in a range. You can see the range, right? No? Let me show you.
Yes, please do.
You got the high. You got the low. Right?
You did it at the little circle.
Yeah, I delete the little circle. The little circle was just to show you that was we won't expect the price to go below that low. So We can have a 15 pip stop, and we can have a 1 and 3 trade, which a 1 and 3 will be right above the highs, which is nice. So that would be risking 15 pips for 45 pips. But you can see, like, this is a trading range, right? This is the range it is in right now. It's not breaking these highs or these lows, but it's inside of a bigger what's the name, just because, you know, you can see the high and the low are still intact. That means it's inside of a range. If they're still intact, that means they're inside of a range. That makes sense?
Mm-hmm.
No, it don't. What kind of questions? You get what I'm saying?
Yes.
Okay. All right. So that's kind of like a good setup that we would be looking for, to be honest. Probably can ride this high up to here, which would be nice, which would be 70, 75 pips, risking 15, which isn't bad. But yeah, to fill in that imbalance, right? You see the imbalance, right? To fill in this imbalance, see that, right?
Mm-hmm.
Because, like, think of like healthy price action. Think about, like, when you think about healthy price action, everything's like kind of trade inside each other. But then you have this one, you know, this one. Let me make it a different color. Can you see that? Maybe
I feel like, yeah.
that works.
Mhm.
Wait, hold on, make it thicker. How about that? So price is like trading inside each other. It went all the way back. Then you got this huge expansion up. So this would be considered healthy, right? Because it's trading all the way into each other, but this is considered unhealthy because it left imbalances in the market, right? It left imbalances, which is this area. So that means price have to come back down to fill in this imbalance to go higher. That makes sense?
Yes, it does.
Perfect.